David Smith, Fund Manager for Henderson High Income Trust. Thank you for joining us this afternoon.
Okay.
So, the UK Prime Minister recently gave a speech saying out the hard facts of Brexit, including that the UK would be leaving the single market. How much attention do you pay to updates like these, and how important is it for your stock selection?
Yeah, I mean, answer it, two sides of that question. Do we pay attention to it? Yes, it's an important driver of where we see the outlook for the UK economy. Does it change the way I think about the stock selection process? Probably not really. Let's remind ourselves how, the investment process is to find companies with good fundamentals, but always at the right price, at the right valuation. And that's to invest over the longer term. So, more shorter term issues such as Brexit, we need to be aware of and we need to apply to our investment process, but we always have to weigh that up versus what do we think is discounting the valuations. And let's not forget, Brexit is very much a UK issue. 2/3 of the UK market are derives overseas. So yes, this is important for the UK economy, but is it as important for the UK stock market? Probably less so.
In which sectors are you seeing most opportunity for paying high dividends?
Well, it's quite interesting. We've just spoken about Brexit, and when we look at the impact on the UK market has lagged overseas markets to a point where actually the dividend yield for the UK market is now at a 15-year high relative to global indices. So I think there are good opportunities out there for income fund managers such as myself. Typically we're seeing opportunities in some of the mega cap space. So Imperial Brands, a tobacco company, for example, it's now yielding over 7%. GlaxoSmithKline, yielding over 6%. BT, utility space, or telcos and the utility space as well, such as National Grid, both yielding over 6% as well. Now, we still have to do the analysis, make sure those dividends are sustainable into the longer term. But actually, having done our work, having a look at the free cash flows of the businesses, we think those dividends can get paid. And actually, given those yields are now quite a high level, we think that provides an attractive opportunity for investors.
In the current climate, investors are mindful of disruptive technologies and their potential to unsettle the stock markets. So as an income investor, how do you approach this phenomenon?
Yeah, I mean, as your question alludes to, it is difficult for income investors. Typically, those companies that are producing that disruptive technology are either not listed, or where they are listed, they're in a high growth phase. They're not actually, they're investing in their technology rather than paying dividends back to shareholders. I think the two ways I think about getting around that is to find either companies that are more protected in terms of the business model away from disruptive technologies. So a good example will be Hilton Food Groups. It provides packaging solutions for supermarkets. It's not a typical industry that can be competed away in terms of new technologies. The other option would be finding those companies where, yes, they're probably under a little bit of technology disruption, but actually they're investing in their business to protect it for the longer term and add a bit of growth going forward. A good example would be British American Tobacco. They've put a lot of money behind new products, new next generation products, so heat not burn. So producing cigarettes that actually don't burn the tobacco but heat it up. So actually you get the same flavours, same feel of a cigarette, but actually it has a less in carcinogens. So it's slightly more healthier option than the full-time cigarettes that we're used to.